Hello everybody and welcome back to the channel. Well, it's little secret right now that we have an incredible fearful market on our hands with massive key support that was tested back in February and March being tested again here at the back of April. Ahead is Apple and Amazon, big earnings and a huge amount at stake. So we're going to be talking about stock, commodities and cryptos today, really breaking down what's at risk for all of these markets and whether they can bounce off these lows and how will we know that things are improving. Stay tuned as we go through everything right now. See you soon. Welcome back everyone to our daily market recap show here for stocks, commodities and cryptos. If you like any of those markets, make sure to subscribe and of course give us a thumbs up if you find value in today's video. We'll be looking at the market close the 27th of April 2022, and straight away I want to take a look here at the heat map of the SP 500. Is there a risk on or a risk off sentiment? In general, mixed. As we mentioned, Microsoft had a pretty good result. Google, maybe not as good as some people expected. And Facebook sold off. However, the after hours report pushed it up around 18%. We'll take a look at that later. Most other things are awaiting here, Apple and Amazon, and you can tell that they're getting absolutely ready on the charts for a blockbuster news event. Depending on how they go, will most likely push the sentiment into the Fed's reports next week. And as we know, sentiment at this stage is fearful. Some people say that when there's fear in the street, you should be looking at buying opportunities, and generally they would be correct. But is there more fear to come? Do we go into extreme fear? We're not sure just yet. It was neutral a week ago, it was neutral a month ago, and now all of a sudden we're in that fear bracket. So things are really changing here in the markets. Let's talk about the actual horizon of what occurred. So we suspected in the previous video that we did that we would get a rally into the open. That was the Asian session would rally and it would most likely be met by selling demand. That's pretty much what happened. We saw a big rally here in the morning. Some markets were up as much as 1.8% on the Nasdaq, and then they fell through the session to end pretty much flat. This is because the big news is in the earnings at the closes of the day. As we mentioned, Facebook after the close, PayPal after the close, they're affecting stock market sentiment. And of course, that was really what was at stake throughout the session. We're at a key support here on the market, so it makes a lot of sense. Sector-wise, it wasn't clear which ones were best or which ones were worse. Some of the ones that got hit in the last couple of days of trade, such as technology, solar, jets, they were up marginally through the day, which is good, but doesn't really tell us or help us with much. Let's talk about some stats though. We'll go through some macro stuff, then we'll go through some lead indicators telling us things about the market conditions right now, some options, and obviously individual stocks, cryptos, etc. And we'll start off here with, is this correction actually average or is it a horror show? Now, many of you may have just come into the markets in 2020 or 2021 or possibly just before the pandemic in 2019. You may not have experienced standard pullbacks in markets. The average S&P 500 pullback, the average, is actually around 14% negative. Now, obviously, there are outliers from that point, and there are points where the market goes down a lot more, and then there are times when it goes a little bit less. We've been kind of used to, over the last, you would say, decade, to nothing less than or nothing more than around that 20% kind of level. So the S&P 500 sitting at negative 13 at this point. Is that bad? It's not shocking. And even though the Nasdaq is down much more than this, we do look to the S&P 500 as our lead. So it's down around 13% currently and could drop a little bit further, possibly to something like a 4,000 or a 3,800 before getting to the average return in terms of how much pullback. We'll look at that a little bit later. The other thing that's interesting is where the Fed is at in comparison to where they've been in the past. Percentage year on year. This is a super interesting statistic. So if you took percentage year on year from the stock market, where it was to where it is now, it's now about to give you a percentage year on year change of -%. Now, historically, over the last decade, what that has caused the Fed to do is actually reverse policy decisions and change the way that they were looking at markets. You can see over here, Yellen unexpectedly delays the first Fed rate hike in 11.5 years, chooses not to do it, and does it later after the market recovers. We also have Powell reversing course on rate hikes and begins cutting rates when the market went negative last time, supporting the market, supporting the economy again. So you can kind of see a reoccurring event here. The Fed doesn't mind the market coming down, but they don't necessarily like the market going too negative year on year. So when we hit something like a 5 or a 10% negative year on year, the Fed doesn't seem to like that, and they tend to try to support the market. Maybe their hands are tied this time around. So we know that April was historically not so good based on the previous data. Obviously, April is usually one of the strongest months in the year. If you bring it up as a statistic, it certainly is. However, like most months that are bad, there are certain things that tend to happen into the end of the month. If we have a really bad month throughout history, 2007, 2008, 2010, 18, obviously the similarities with 18 are very similar here because of midterm elections. It's funny how the last 3 days left of the stock market on average had actually been positive. So the stats would say, and obviously every time is different, this is just stats, but it can help if you've got technical analysis coming with you. 91.7% of the time, the final 3 days return positive. It's going to rely a lot on Apple and Amazon's returns. But if they go bullish, is this going to be another one of those statistics where we see a rally into the close of the month, which so far has been a bit of a horror show on the S&P and Nasdaq. Let's move over to Shiller PE ratio. A lot of people look at this as an idea of whether stocks are cheap or not. Stocks are coming back to a level that's a little bit more reasonable. So again, is this a healthy pullback? Some people would say it's totally not, and the economy's in a recession. I think we've talked about several reasons why we believe that may not be happening right now. And at this point, are we getting back to a more fair average for the 10-year Shiller PE? Well, yes, we are. We were super extended away from that level. Are we getting back there now? Well, we're starting to get back down to that zone. So we're still very, very high on the S&P. Obviously, we're trying to get back to this kind of price here in terms of the average 10-year Shiller PE. So there might be still a little bit more to fall to get it to that average if we believe that's where the value is. But the value improves per day for people that like DCA strategies, etc. Another thing that people are deciding is, are we in a recession? Now, often in a recession, what will happen is we have a new paradigm shift. That is, everyone's hyper on the markets. It will never stop. It's all going to be good. Then we go into denial, arguably what happened during January into February. Then we have a bull trap, which is a return to normal, which again, a lot of people are making that argument for. The real key here is, if we drop through this level, do we go on a ballistic move down? And that's what people are worried about. If we go through the support of the SP 500, are we entering capitulation, fear, the real crash of a market? And that's what's at stake here coming into the Fed next week, and obviously Apple and Amazon. We're on an incredibly important support at this point. I've discussed how percentage of US Treasury yield curves that are inverted, generally if you get over 50% of all of them inverting, I think that's a really good early bird kind of signal that we're going into a recession. We currently don't have that. So that's a good sign for the US economy. We also know that midterm years are incredibly hard. I'm going to leave this chart just for a second, but I'll get off it. And that is that there's often multiple pullbacks through the year. We've always said that. We've been consistent with this idea. We were trying to snake through, of course, the idea that April might rally and that it would dump into the earnings. It dumped a little bit early there. And of course, now we're dumping in earnings as well, which has been really the problem, I guess, with the markets this year. Is they're following general gist of the 2022 midterm kind of year, being up, down, and a trader's year, but you need to know which sector to go into. If you were trading the right sectors in April, you certainly weren't down very much. If you were trading only tech, of course, very brutal times, unfortunately, there. Let's move over to the beat rate here for the earnings. We've got 79% beat rate, beats 375, misses 100, so still very nice earnings out of the US economy. That's not necessarily a bad sign. And as we move forward, as we mentioned, Meta, Facebook up after hours significantly too. It was up 18% plus after hours after going down. Be careful out there, guys, for the fake news that's being put out by some of these websites. There were reports of leaks of the Facebook news. Algorithms got hold of that and shorted Facebook. It was fake. The reality was it wasn't the real news. And then all of a sudden the real one comes out and we're up 18% after hours. Be very, very careful of fake news coming out. We've seen this quite a few times. Remember that Walmart Litecoin thing that happened last year? Be careful of that moving forward. I think it's going to become more prevalent as we go more towards decentralized kind of news and everybody having more of a say on what's going on. Not so much ramifications for giving out false information. PayPal also had a report. It looks like it went up slightly, and Spotify really suffered throughout that last session. So our eyes really become basically on these ones: Apple, Amazon, and to a lesser degree, things like Roku, Intel, etc. Will Apple and Amazon, kind of the hallmarks of consumer discretionary, I know Apple's not in there, but Amazon is, the American consumer, 1/3 of the US economy, will it hold up? So far, the signs are not looking positive, but they're not necessarily looking super negative either. We know that the markets are selling it into supports. We'll take a look at that in a second. We also know there is fear in the street. Remember, if we're reading fear here in the markets, everyone, the way we look at it together is we see here that when fear hits 35, that's possibly a level that we need to be saying, well, should we be greedy at that point? Are we hitting a level of support? Have we seen the bottoming of the market for at least the intermediary kind of period, maybe a day, maybe a week, maybe a small period of time? So we do want to be looking here always at the fear index. And at the moment, the fear is high. 31.59 is not usually normal on the VIX, and we can tell that there is a lot of fear leading into these news results. US 10-year as well, that's been climbing a little bit after dropping. Remember, the higher US 10-year goes, at least initially, it's bad for technology and possibly good for things like commodities, yeah? The higher inflation goes, the better the commodity trade tends to be. Now, we know that the US 10-year is sitting right at 3% or around 3% just recently. It's sold off that area. This is a zone that every trader in the world that knows about sector rotation and movement is watching very carefully. We want to see, firstly, real yields, which we'll talk about in another video, so make sure you subscribe for that. But also we want to see that this 10-year can hold underneath here if we have a chance that things like the technology sectors will come back in a big way. Another worrying sign is the US dollar index. I'll leave it zoomed out here just to put this in perspective. The highs of 2017, the highs of 2020, during obviously the crisis period, we saw a lot of money flowing into the dollar index. That is getting out of the market and flowing in. The reason you can tell that people were hedging is look at this. Just after the market bottomed, what happened? Huge amounts of money during that crash jumped straight into the dollar index. They fled to safety. The US dollar is a hedge against uncertainty. Cash is king, sometimes people say. Right now, money is floating out of currencies around the world. Euro, US dollar, pound, US dollar, everything's getting destroyed. And yet the DXY continues to power up while we see sectors across the board in the US collectively sell off. Again, fear is in the street at this stage, and this is a direct reflection of that. We're at the resistance. Will it stop here and float back into the stock market? That's going to be a very interesting thing that we must watch, and DXY should be on the watch list right now. PCC, put call ratio, again, decent amount of puts being put in, a little bit more than calls in the last 24 hours, but overall we've seen a huge rise of calls in the short term leading into these earnings results. The market's taking full advantage of that. We'll take a look at that soon. We've also got gold. Gold broke through the support here. That's why we caution against buying that last level. It's not looking so good when you got a falling knife coming into it. It seems to have broken out down below. That's mostly a negative towards gold. And you would think, again, any rip now could be met by sell demand. So be careful in the gold trades, guys. We suspected this would all be going bad after it hit our 61.8 fib, which was right around just under 2,000 an ounce. I think 2,000 an ounce was the 61.8 fib. And now, all the way back down it goes, unfortunately, for this one. I'm not sure where the gold will turn around. It's not as clear anymore. Remember, gold is good to trade 10% of the time and great 2% of the time. And the rest of the time, it's kind of a scary market unless you know what you're doing. Natural gas, that was certainly the one that we pointed out over the last couple of days that we had some clarity on. Really great trade here, back to the 61.8 fib. So if we take the Fibonacci here of that, look at that, smash straight into the 61.8. Good take profit if that's your first one. Some people will try to hold natural gas to get it up to the inverse head and shoulders, left shoulder, head, right shoulder, all the way back up. Totally understand. We'll see whether that occurs, but certainly a great little scalp there coming through, and fantastic day trading opportunity on natural gas. Still looks more bullish than bearish at this stage. Tesla, it's not looking too good here. You know, we go over to Tesla and we know it's on support. Obviously, it's reliant on sentiment in the markets. Support, resistance. The rally was met by sell demand. That is the market we're in right now. Every single rally at this stage is being met by sales. That is, everyone's going, I'm getting out, I'm scared. I don't want to hold my position into the Fed next week and obviously into Apple and Amazon's earnings. So we now have a low and we have kind of an equal low. Could this become a double bottom in the future and it breaks through 920 and then we feel much better? Take it into obviously the 975. I think that's a very relevant and serious thing that we could consider. We could have a low here. It could bounce based on previous statistics. We've seen if we had a bad month, the last 3 days can be kind of bullish. And if the market does bounce here in Tesla, what's the next zone? Well, you'd think if it breaks through 975, very clean level, yeah, for us to be targeting. Obviously underneath here, not good at all. The Tesla bears come back in, and the next level I think is going to be something like $800 flat. So if it breaks below, not so good for Tesla. If it breaks above, we have clear levels. Good trading, I think, ahead on this stock if we can continue following it. Let's talk about Facebook. So as we mentioned, there was fake news that came out. It went down. So it actually had a bit of a switch here on the day. So let's look at that. 6.48% down from top to bottom in terms of where it went through. Now you'll notice I have a line here. Let me just bring that out to a weekly. Check this out. A literal trend line that goes from 2013 into 2009 and into 2020, and we're there. We close below on the daily, okay? But straight after, we get our earnings result and it bulls really hard. I think it was 208 or something last time I saw it. So it was like up here. So a significant candle. What can we expect from something like Facebook? Well, do we expect that it probably will hold that? Do we think it can hold that earnings result? Most likely not. I think people will see that and they'll try to take some profits before, of course, the risk of the Amazon and the Apple earnings. And we maybe scroll down a little bit. Possibly we go to 200 or we go to 190. And do we then see buy demand? Well, that's going to be the big question. And I think this becomes interesting because clearly the earnings result, whether you think it's good or not, the market, how it reacts in the next 24 hours is really going to show us whether it's just done max pain, effectively causing a low that takes out people's stop losses, that makes people place shorts, and then reverses it, putting the pain on those trades. So watch Facebook. I think we might actually watch this for a few days here and see how it trades around. If a rally is then met and it goes above the previous trade, what's happening then? It's kind of showing you a momentum could be pushing the trade back into a 230, 235. So this is a very interesting stock now, all of a sudden. Amazon ahead of earnings, right on support. As we suspected earlier this week, it's pushing its way down and it's opening right around support. So depending on what happens here, you can see what's at stake. I mean, if Amazon goes short underneath this support, where's the next level for it? I mean, it could be pretty brutal sell-offs. And when we go through the indices, you're going to see why. Amazon here, bam, bam, bam. If it gets underneath, would it go to 2,400? That's probably the next level. Then 22 after that. So again, we start looking at the Nasdaq and the SP500 for heavy supports at that point. Apple is similar. Rally, sell straight off. As we suspected, they continue to sell the rallies at this stage. And until we see the lightning bolt reversal, that is some kind of change of trend, the double bottom, similar to the Tesla trade or anything like that, we can't be sure that there's a bottom in these stocks. So Apple moving down here, whether you think this is the support, this 155 or a 152, we don't know yet, but certainly a big support going to be tested ahead of the earnings result. So again, Apple's putting the markets to the test. IWM is actually breaking low. And this is, again, another concerning one. This is the small cap companies. Now, IWM is known for giving false signals, so you've got to be careful here with it. But this was, in the end, a distribution with obviously a false break that had that rally in it. We then see it break underneath this zone, consolidate, is the weekly, going to hold underneath this zone? If it does, what does that mean for us? Does this mean that the market's going to tank down to 170? The bears get full control? You can see how much is at stake in some of these markets. At 170, do we like that level? Well, you'd have to say probably. I mean, you look at this market and you think, damn, that's a pretty damn good level. But that's another 10% away if the market does fall through on this market. Now, of course, IWM will move faster than the S&P or the Nasdaq because of its nature. The DAX, another one that's broken below and now coming back to retest ahead of the Apple and Amazon earnings and the Fed next week. Again, a lot at stake here. Downward trend, though, is really cool. So in the future, if we ever see it rally like this and it breaches that downward trend, I would say that's a great indicator of risk on. I think we'll bring that back quite a few times over the next few months as we start to see this play out. Could be a week, could be a few days. We don't know yet, but certainly looking much better. The Nasdaq, clearly testing the lows in the close. Rally, previous support, resistance, as we suspected, exactly what we suspected, which is selling the rip at this point. And we await the news on support. Futures, because of the Facebook earnings pushing a market back up and Microsoft being okay as well, we're really testing right on that resistance here into the open. You can see on the futures 13.2, on the real market, it actually works out to be 13.240-ish, 13.230. So a little bit higher there. But so much at stake. Put this on a weekly. You can see taking out these lows will significantly move the market, and ahead of the Fed, we could see it go all the way back down here to possibly even a 12,000 handle or a 12.4. That's another decent amount here, 4-5% down fairly quickly. And it's consistent with what we think about the SP500 as well. Again, rally met by sell demand. We're on a 2-hour chart here. You can see the supports previously, 42.40 now, the high. So for us to get a bit more bullish on this market, wouldn't we want something like this, a double bottom, similar to the Tesla trade, breach through that 2-hour 20, breach through, start to push back up, start to show us there's a recovery in play? Do we want to buy this support? That's the question you've got to ask yourself, again, ahead of earnings. If you do you want to scale into that trade? What kind of risk do you want to take? These are all the questions that unfortunately we have to take and we have to think about. They go to the weekly here. Here's the weekly. So much at stake. Next level after this, as we've discussed, probably 4,000. Why? 4,000 is the 100 SMA. Theoretically, that's the most statistically likely thing to occur in terms of just the raw stats of things in the past. After we closed below 50s, we've tended to go towards the 100. So will we do that again? I'll show you where the 100 is. Let's just quickly switch this 200 to 100, 100 weekly. There it is, sitting at 4,030, but pretty much 4,000. So again, a lot at stake here coming into the weekend. Now let's look at max pain. Have the market been very sneaky about what they've done? Well, I think so, because stock price closed at 420. Max pain for the 27th, the close of the 27th, was 423. They managed to get it incredibly close, guys. Really, really close. Let's look at max pain now for, as it sits, the Friday expiry. 433, current price 420.60. Now, depending on what happens and whether they can suck more calls into the trade, maybe the max pain comes down over the next 24 to 48 hours. If it does, will they close it right on? They're pretty close right now to making significant money from that max pain. It doesn't always happen like this, but it's interesting they're managing to hold and bring people into the calls and bring people into the market in the perfect way that they like to do so. Bitcoin is showing some signs of recovery here. It keeps failing each time. It keeps going down and then coming back up and then going down. It seems to be having like really small relief rallies. At this stage, the daily 20 seems to be holding it back down. I'm not convinced about direction here. I mean, if we close above 42,000, I think at that point you're saying, okay, cool, we can go long there. There's probably a decent trade into the 44, 45 kind of range from a technical perspective. And if we look at BTC shorts, that continues to rise. We're almost breaking through to a new high here, showing us the whales are placing shorts and removing positions. So that's something that's important. If you haven't already followed us over at FX Evolution on Twitter, definitely consider doing so. We're over there at FX Evolution. And remember, the big news coming up is all about next week after Apple and Amazon. These are really a super 2 weeks. We not only have the FOMC funds rate and press conference. That's going to be a horror show. We'll find out what happens there. But on top of that, we've also got non-farm employment change, the US employment change coming out. Another huge number, and obviously one of the biggest bits of news that comes out every month. So if you want to follow along with this journey that's going to be going over the next 2 weeks, and of course the rest of the year, please remember to subscribe, smash that like button, and we hope you found value in today's video. Thanks so much, guys. We're well on the way to 100K, and that's thanks to all of you supporting the channel. We appreciate it. Bye for now.